Good afternoon, everyone, and thank you for joining. We're going to let everyone continue to log on and get started in just a couple of minutes. Thank you. All right, let's go ahead and get started. Hi, everyone. Thank you for joining today's webinar, Healthcare Industry Tax Update 2023. Today's program will be presented by Scott Mariani, Partner and Practice Leader of Witham's Healthcare Services, Matt Walsh, Partner and Market Leader of COVID Financial Assistance Services, Lynn Musensky-Keck, Principal and National Lead, Federal Tax Policy, and Haley Stout, Senior Manager, and Bill Hemmer, Senior Tax Accountant of Witham's Healthcare Services team. Before we begin, I have a few notes. Today's materials can be found in the toolbar on the right of your screen and will be distributed to you after the program. Also, at the bottom of the toolbar, you will see a questions box. Feel free to send us your questions during the presentation. We will do our best to address them at the end. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, when the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. I will now turn it over to Scott.
Thank you, Rachel, and good afternoon, everybody. Thanks so much for joining us here today. Today's presentation, we've broken it out into 4 parts, and you can see our agenda slide here. First part is clean energy refundable tax credits and the Inflation Reduction Act of 2022. We'll then transition to providing an update on the employee retention tax credit. Part 3 of today's presentation will be a current federal tax issues update for healthcare organizations, including recent IRS audit examinations of healthcare organizations. And then we'll wrap up today's presentation with Form 990 Schedule H community benefit update and best practices for tax-exempt hospitals. So with that, it is now my pleasure to turn the program over to Lynn Keck. Lynn, it's all yours. Thank you.
Thanks, Scott. We're very excited to be with you today to talk a little bit about the clean energy tax credits. As many of you know, we'll advance to the next slide, that this was passed in August of last year. Overall, it was a revenue raiser bill, but there is a significant amount of investment that the federal government is pushing back into the marketplace. And so you can see from these very high level slides, they're estimating to bring in $739 billion. Not a lot of tax related revenue in this, except for very large corporations, which are would be assessed the corporate minimum tax. But there is a lot of investment out there for every organization. And it's the Inflation Reduction Act focused a lot on infrastructure. And so they do want better energy security and climate change programs in the United States. We've all been seeing the significant weather-related catastrophes essentially that have been happening across the US and the world. And so this is really the push the US federal government is approaching to get this infrastructure built in a designated time period. They can't do it themselves. So they have a variety of programs pushing out $433 billion to a variety of taxpayers that I think some will be very low-hanging fruit for many of you on this call. Next slide. Before we get into too much detail about four major incentives I want to talk to you about, I do want to talk about the high-level changes to the credit system. They're very important for us to understand and ensuring we're asking the right questions when we're in a particular credit area. So when you do think about clean energy credits, you might say to me, Lynn, how do you say the federal government is actually investing more? When previously, before the Inflation Reduction Act was passed, I could have a percentage base of 30% of cost I put into clean energy, and now it's only 6%. And the reasoning you'll see a lower base percentage is essentially the government is saying, we want you to put these projects in certain areas. We want you to make sure you're paying certain rates when entering into these projects, and to ensure you would essentially do what the government would do, we're incentivizing you. So while the base percentage might start at 6%, what we're going to see through a variety of tiers is that the base percentage could go up to 30%, for example, if you meet the prevailing wage and apprenticeship requirement, pay people the prevailing wage. Essentially could go to 40% if you're in certain energy communities. They're very well versed in this area that they don't want an energy divide, meaning that in the low income areas, there would be no energy, clean energy, but in the wealthier areas, they would. So you'll see that spattered throughout the code. And then on top of that, they have an additional 10% if you meet certain domestic content requirements. So think about if the government actually put in the infrastructure, all these things would be being monitored. And because they need the general business person's help to move this infrastructure along within the selected time period they would like, these are all types of tiers they're requiring you to meet. And they're different depending on which energy credit we're discussing. The next item that I'm really excited about is the not-for-profit direct pay option. So previous to the Inflation Reduction Act, a lot of not-for-profits were interested in these credits because they had to generate tax liability. They had to have UBIT. And a lot of our not-for-profits would say, well, I don't have that much that would incentivize me to really commit to these large energy projects. Well, now under the Inflation Reduction Act, they really blew open the credit system for the not-for-profit group. And they essentially said, you know what, even if you don't have UBIT, even if you don't have taxable income, we'll allow you to claim this credit as if you pay federal income tax to the federal government, meaning essentially that you get a refund after you file your tax return. So essentially changing non-refundable credits for the not-for-profit sector into refundable credits, a huge change. The third piece of this is for our for-profit friends who might say, Lynn, I unfortunately don't create enough tax liability for me really to be engaged in these types of activities. And I would say, okay, a couple things I would point out. They've really extended how you can use this credit. You can carry it back 3 years, you can carry it forward 22 years. So even if you maybe don't have today tax liability, did you have in the past 3 years? But even if you can't get into the carry back and the carry forward periods, you can still transfer the credit, which means you can sell the credit to another person who could utilize it. Before, we would have to do very complex tax partnership structures to do such a thing, and they've made it very clear now that you can transfer certain credits, which essentially means you sell them. And when you sell them, you don't have to pick up the income, and the person who purchases them doesn't recognize an expense. Next slide. So today we're really going to focus on four main incentives. The first three are credits, and why I highlight that is credits are really what we want, right? Credits are a dollar for dollar deduction in our tax liability. If I owe $1 million and I have a tax credit of 1.5 million that's refundable, then I get $500,000 back. Really a great incentive. And the fourth item on this list is section 179D. Now that relates to a deduction. Now for some of my not-for-profit friends on the phone, they might say, well, I don't really care about deductions, Lynn, because I don't generate taxable income. You should still care about 179D, and hopefully we'll get to talk to you a little bit more, but essentially because you can use that as a price negotiation with architects and engineers who are either building you a building or renovating a building that will meet the energy efficiency requirements. So this slide is really great for you to utilize because, like I said, that two-tiered structure, whether or not it's a direct pay opportunity for not-for-profits or whether or not you can transfer the credit is really dependent on which credit we're talking about. So here's a high-level chart that will help you with the four we're going to address today. Next slide. So I'm really excited to talk to you about the energy credit. Some people like to refer to it as the investment tax credit. And so essentially here they're saying, we want you to invest or be involved in certain energy projects. So let's highlight some of the differences that have come into play. Well, first, not-for-profits really didn't care about it previously because they couldn't obtain a refund. So now they're in play. Second, they've added a lot of additional energy projects that qualify now. One, which is getting a lot of traction, is the energy storage technology. So if you have an energy storage technology that you're putting into play to capture maybe additional solar energy or just backup energy storage technology, provided it's clean, you're going to be able to essentially access a credit. In addition, what we're seeing a lot in our space is combined heat and power system property, which is often referred to as cogens. So for example, in the Northeast, we had a facility who said, well, I started a cogen facility. Does that mean, and I started it prior to the Inflation Reduction Act, does that mean I'm not available to the credit? And the answer is no. This credit is based on when you place the property into service. So we can work with you, even if you've started a project prior to 2023. And really, there's a significant amount of funding here that can help you. So for example, in the Northeast, we're dealing with a couple hospitals that have a variety of cogen projects, and we're looking at credits that expand between $4 and $7 million per cogen. So significant here. Other items which aren't listed on this that I would say is also an energy project that we see a lot of people involved in is solar power. So if you're involved in solar panels, that's another big energy project that you can receive a tax credit for. You might be sitting there saying, well, how do we even get an idea of what this looks like? So at a very high level, just so you know, Witham works essentially with the facilities to really look at what are you going to be your capital improvements. What we found in a lot of healthcare spaces is there's already what essentially we nickname a green committee, which essentially has been a committee put together saying we need to invest more in clean energy, we need to become more energy efficient, and we need have this allotment for capital expenditures. And it's really important to pair with your tax advisor to say, how are we going to structure this? Some of these credits, for example, this particular credit ends at the end of 2024. A similar credit starts in 2025, but it has additional requirements. So should we potentially put that cogen facility in before that time? Look at those solar panels before that time? So those are all different types of discussions we have with this Green Energy Committee. So next slide. So now we know some of the items we might be looking at that could potentially be open to a credit, and for not-for-profits, a refundable credit. But what is the percentage we're applying to that cost basis? So the percentage we're applying to that cost basis, like I said, will start at 6%, and it could go to 30%. And I'm really going to stress here, if either or of these tests are met, right? Not both. So what a lot of people are missing is, I don't have to deal with the prevailing wage and apprenticeship requirements, which can be onerous, if I can prove that the project I'm putting into play is less than 1 megawatt of electro or thermal energy. Automatically, I'll be at 30% at that point. That's a good answer. If you do have to have something greater than 1 megawatt, then you have additional requirements to get to the 30%, essentially proving prevailing wage and apprenticeship requirements, which oftentimes is easy to meet on the East and the West Coast, but is administratively burdensome for documentation. I can raise that 30% credit, 30 cents on the dollar return from the federal government, to 40% if I'm in an energy community. That might include a brownfield site, but also includes other low income areas that are surrounded by coal or oil generation. Or I can actually even increase it all the way to 50%, so 50 cents on the dollar, if I can meet a specific domestic content requirement in that energy project. So that's really great news for our participants today. Next slide. At a very high level, we're going to look at these energy projects and we're going to develop a basis. And what I'm going to caution you is, don't just say, well, I paid X for the cogen, because that's my basis that I'm going to apply this 30 or 40, 50% credit. You really want to work with your tax advisor to say, was there interconnection property that I should be aware of and including in that base? Did I store the cogen facility in its single loan building? And does that building now get brought into the basis I could take against the percentage? These are all different types of questions that you should be vetting to really expand that cost basis that you're applying to the 30, 40, or 50%. In this particular example, it's 25 million. We were able to say that the applicable percentage was 40%. So we're looking at a $10 million essentially refundable credit for the not-for-profits, or a credit that can be applied to tax liability for profits. And essentially how you would gain that credit, there is a timing delay. You should be aware of that. But essentially, for not-for-profits, we would say, okay, here's the credit we want to apply for. We're going to put it on the 990T for the taxable year we placed it into service, and then wait for the federal government to give us our refund. Similarly, for-profits would also put it on their compliance returns and either look to receive a refund or look to reduce their tax liability or do a carryback or carry forward. I would say these are large numbers going on your tax returns, so documentation is really going to be key here. Next slide. At a very high level, I'd also point out that there are qualified commercial clean vehicle credits. So commercial clean vehicles you utilize in your trade or business. I'm not going to go through the definition, but I am going to highlight the two bolded items on the bottom. The definition of a commercial clean vehicle is very different than the definition of a clean vehicle for purposes of individual credits, right? So if I go to an auto dealership and I say, I'd like to purchase an electric car, my requirements there are very different than the commercial clean vehicle. And the two I'm highlighting to you is a commercial clean vehicle does not have to be finally assembled in the United States, and there is no critical mineral or battery requirement. Therefore, the ability to capture this credit for businesses is extremely wide. Next slide. At a very high level, you can flip through these slides in the future, but I would point out for gross vehicle weight of less than 14,000 pounds, we're looking at 7,500 of a credit. So think about a car that transports people amongst the various facilities. For a gross vehicle weight above 14,000 pounds, you're looking at a potential credit of up to $40,000. And in that space, we're looking at, could be portable medical facilities, it could be ambulances, it could be buses. So there's a lot of different arenas or levels that we might be hitting that $40,000 amount. Next slide. Obviously, if you have a commercial vehicle that's electric, you also would need probably a charging station. And so the question then becomes, well, what if I now have to install charging stations? Can I indeed also obtain a credit for that? And my answer is going to be, it depends. And I don't want to burst your bubble regarding this, but there's so much bad information in this particular subject area out there. Prior to the Inflation Reduction Act, it didn't matter where you put your charging station. You potentially were open to the credit. Under the new Inflation Reduction Act law, they require you to place the charging station in either a low-income community or not an urban area. If you don't meet either of those tests, you're out. So the first thing you're going to want to do is really make sure you're in those areas, those designated areas as defined by the Internal Revenue Code. Then once you're in those areas, again, your base percentage will start at 6%, and then you can increase it to 30% to the extent that you can prove the people who are installing, their contractors, the subcontractors installing the charging stations were paid a prevailing wage and met the apprenticeship requirements. There is documentation there that you as the taxpayer need to be involved with, and you need to work with your contractors to make sure that it's in the legal documents that you can get that information. The other thing I would point out is the credit has blown up. Previously, I would only be allowed a maximum of $30,000 per project. A project would be, for example, putting 5 charging stations in one location. Under the new law, what they say is, we're not going to limit you per project. We're going to limit you per charging station. And instead of it being $30,000 per project, they're going to allow you $100,000 per charging station. Again, capped at 30% of the overall costs. Next slide. So here is a quick example that you can look through later, but essentially highlighting that there is going to be a lot more credit available under the new Inflation Reduction Act. So just looking at what did I pay for the charging station isn't enough. We want to evaluate installation costs. We might want to evaluate additional costs that you normally wouldn't have because the amount was so limited in the prior years. Next slide. Last but not least, I'll do this at a very high level before handing this over to Matt Walsh, but the 179D deduction is really extremely important to both parties, the for-profit party and the not-for-profit party. I think the not-for-profit group is sometimes not as aware as what the 179D deduction could do for you. So essentially, the 179D deduction is requiring you to make energy efficient buildings. That could be you're building a new building, that could be you're renovating a building. Essentially, what they want you to do is show that you have increased the energy efficiency at least 25% in relation to certain standards. Previously, that amount used to be 50%, so it's much harder to fall under a 179D deduction. But if you can prove, and you have a variety of ways to prove it, through your different renovations or the building of the building that you have energy efficient building of at least greater than 25%, then now you're allowed this deduction. Now, for my for-profit friends, you would say, well, what's so big about the deduction? Well, think about the things that for your energy efficiency, you're going to put in new windows, you're going to put in a new HVAC system, you might put in new doors. All those items generally would have to be depreciated over 27.5 if rental, or 39 years for commercial buildings. What the 179D deduction does is say, we're no longer going to make you spread it over 39 years. We're going to group it all into one immediate deduction, almost like bonus depreciation. And the beauty is, this is something I think more people are going to be targeted on, because as we all know, bonus depreciation is only 80% this year, goes down to 60% next year, etc. So how do we drive a significant deduction in the current taxable year? For my not-for-profit friends, they're going to say, Lynn, taxable income is irrelevant to me. Whether I get the deduction over 39 years or it all is driven, not really a big deal for me. But what is a big deal for you is you can transfer or sell that deduction to your primary architect or engineer. And by selling that deduction, that absolutely will allow your architect or engineer to take that full amount. So say you invested $2 million that fell under 179D, you would give that $2 million deduction, immediate deduction, to your primary engineer or architect. Well, how does that help me? Well, hopefully it helps you, my not-for-profit friends, in the price negotiation space. If you're giving them a $2 million deduction and their effective tax rate is 30%, you just save them, right, $600,000 in taxes. That should somehow come into your price negotiation. So now we jumped through a lot in this short period of time, but we're going to go to our first polling question.
Right, here's our first polling question. Do you anticipate qualifying for clean energy credits in the 2023 taxable year? When you're getting your votes, leave it up for about 20 more seconds. All right, I'm going to go ahead and close it out. And here are the results real quick.
Great. So yes, 10% and 26 maybe. We have some planning to do around this. So that's a great answer. Now I'm going to pass it along to Matt Walsh to talk about the ERC.
Thanks, Lynn. Appreciate that. And don't step away from your computer too quickly. I think we're going to head right into our next polling question.
Yep, we are on to our second polling question. Has your organization filed for the ERC, and if so, what is the current status? About 25 more seconds.
This is always an interesting one to see how the spread happens, as many who have been involved in the ERC process know that payment and processing time from the IRS has been less than optimal over the last 2 years or so.
All right, about 5 more seconds. I'm going to close it out. Okay, and here are the results.
Let's see the results. All right, so it looks like about 25% have filed for it in some capacity, and have either received or are receiving payment. Another 12% have determined that they weren't eligible, 20% haven't looked at it yet, and 45% don't know. That's okay. All right, perfect. Thanks, Rachel. So yeah, so the employee retention credit, you know, as Lynn mentioned as well, we have a lot of information in the slide deck, and some of it is meant to be a takeaway for you. And what this first slide is essentially going into the employee retention credit at a very high level. It's a refundable tax credit. For those of you who applied for it, you are well aware, and really the goal of our presentation today is give you an update on the landscape of what the ERC is. So we can go to the next slide. The next slide presents some information on the overall test for eligibility. specifically with respect to the healthcare industry, what we've seen in most instances is that although there were significant impacts from COVID early on, they may not, organizations, hospital systems, doctors' offices may not meet the significant decline in gross receipts test. However, there is potential eligibility under the full or partial suspension of operations test. What we see a lot of is this surrounding government orders in the respective states prohibiting elective surgeries early in 2020. This could be, depending on your state, it could be 50 days, 70 days. But if a large portion of your operations depend on elective surgeries occurring, right, you could potentially qualify for this credit. Next slide, please. So the applicable aggregation rules, this is something that we do see a lot of in the marketplace that are either misinterpreted, misapplied, or in some cases ignored altogether. And we've seen some IRS warnings around the aggregation rules. So aggregation rules are a concept that determine what companies or organizations need to be considered together for purposes of determining their eligibility. For-profit institutions, it's generally relating around ownership structure. You can have a parent-subsidiary relationship. You can have a brother-sister aggregation relationship whereby groups of individuals or a family will own multiple entities. And specifically in the healthcare industry, you can also have what's referred to as affiliated service groups, where you have companies that are affiliated with each other, and you have, maybe like a PCMSO relationship where you have a management company that's providing services to another organization, and that could trip aggregation. We've seen a lot of service providers out there not truly dig into the aggregation rules. We've actually seen some calculations done by some of what the IRS calls promoters that basically just completely ignore aggregation, and they have a disclaimer in their memo that says they ignored aggregation, which obviously is not ideal. So it's just something to consider, especially in the healthcare space, where you have a lot of companies that have multiple relationships and multiple ownership structures. Next slide, please. So again, this is really for more information level. Small or large eligible employer does have a significant impact on the overall employee retention credit. This is a secondary sort of after eligibility determination consideration. If you're a large employer, you are limited to including wages as qualifying wages. To those, you're paying people not to provide services. If you're a small employer, you would be able to include all wages paid to employees. Obviously, this credit is fairly significant. It's a refundable. For those of the 21% that haven't considered, or the 45% that aren't sure, this is definitely something that you want to take a look at, a little bit more closely to see if your company or your organization qualifies. Next slide, please. So this is really where the update we wanted to give you. So the IRS has started to dig in on the employee retention credit. The next two slides actually have a couple of instances of warnings. Over the last, let's say 6 months now, the IRS has issued what I think it's now 4 or even 5 as of this week, warnings to taxpayers, indicating that there are tax credit shops and there are what they call promoters out there who are taking a very aggressive eligibility position and soliciting companies to qualify to apply for this credit. They say that the IRS indicates that an example of that would be that there's no risk, that a promoter would say to you, well, there's zero risk to you to apply. Contingency fees, 25%, 35% of the credit is another example where the IRS says that, says that you should be aware. And then just in general, the IRS has a warning. And if you want to go to the next slide, I think there's actually a really good quote on this from the previous acting commissioner. As many of you know, there's a new IRS commissioner that was approved by Congress. This gentleman was Doug O'Donnell, was the acting commissioner, and he just went back to his position as head of enforcement. So I think what we'll see is that this quote kind of dictates how the IRS is going to look at this in the future. And And I think what he says here is that if and I think this is really important, if you're working with a tax professional and they're raised questions about the accuracy of a claim, then taxpayers really need to heed their advice and really need to listen to them. So make sure that you're consulting with your tax professionals and that they're understanding and aware of your ERC positions, because it's really important to get this credit right the first time. The IRS has reminded taxpayers many, many times, you ultimately are responsible for what you put on a tax return, what you report on a tax return, and that if there are interest penalties as a result of audits, you're going to be responsible for them regardless of whether there's a third party who helped you with the calculation. So you really want to be confident that you're doing this the right way. We go to the next slide, please. So here's what's happening, right? The IRS is opening audits, right? They've indicated they're conducting civil and criminal investigations into the employee retention credit. What we've heard is that the criminal investigations so far are generally surrounding some promoters that have been found to be acting not in good faith as far as eligibility and as far as as far as claims that the IRS believes are fraudulent. But what's also happening is the IRS is staffing up on the audits, right? The IRS views this as a significant area for improper positions, and views this as a potential significant reclaim of taxpayer dollars for those companies that claimed it improperly. We at Witham have helped many companies through their IRS audits. For example, I think we just finished up an audit of a healthcare system with the IRS. There resulted no change from what we had originally assisted the client with, and I think that claim was in excess of $5 million. We've also done other non-healthcare IRS audits through whether it be for-profit or non-for-profit. And the IRS is really digging in here, right? They're looking at every aspect of the employee retention credit. They're looking to make sure that the organization qualifies, that if you're relying on government orders, that those government orders have a basis in fact. They look for the government orders specifically. They look for how you are impacted by those government orders. And in some cases, they're auditing the claims before they're paid. I think the IRS finds that it's easier to keep the money in the treasury than try to get it back after it's all gone out. So what we've been seeing is an increased enforcement around auditing these claims before the cash gets out the door to the taxpayer. And I think we're going to continue to see that increase, over time, right? This, unfortunately, is an area that the IRS is digging in on. So we'll see that enforcement continue to increase. Specifically with respect to, kind of to close out our discussion on the employee retention credit. I go back to the poll. There's about 45% of people who said that they weren't sure about their ERC claims. Specifically with respect to healthcare organizations, we do see eligibility for many of these organizations for at least a portion of time, right? It may not be the sort of you're eligible for the entire length of the program like some of these companies out there are saying, or you may hear on the radio, but the eligibility that an organization does have is creating significant cash, refunds, and these opportunities are certainly something that every organization should be looking into to make sure that they're taking advantage of the program when they're rightfully eligible. We've helped thousands of companies. We have a really good collaboration between our ERC specialists and Scott, Haley, Bill, and the healthcare team. And we've had a proven success at the IRS audit level with some of the cases that we've helped. So if you haven't taken a look into this, I would definitely recommend that you start. But again, make sure, and even if you have taken advantage of it, and you maybe feel a little bit uneasy about a position that was taken, it's definitely something you should reach out to and we should talk about. So that is the employee retention credit update we have for today. So without further ado, I'm going to turn it over to Scott.
Thanks, Matt. Great job, Matt and Lynn as well. There's really exciting tax credits and refund opportunities in both areas, and Witham strongly advises you to have that conversation with your advisor or our firm with number one, the Inflation Reduction Act, which Lynn covered. It's brand new and it runs for, I think, the next 10 years or so. And certainly, the Employee Retention Tax Credit came about, believe it or not, as a result of the CARES Act, right, in March of 2020. And here we are in March of 2023, and we're still talking about Employee Retention Tax Credit. And unbelievably, taxpayers still have not even had that conversation or even determined whether or not they're eligible. But there are dollars out there from a federal perspective for healthcare organizations. So I've got part 3 here of today's program. It's certainly not as exciting as what Lynn and Matt talked about. But if you've joined us on any prior healthcare tax webinars, these are not new concepts, but we keep finding issues with them. And when I say we, it's us with them as tax advisors, but also with respect to the IRS. Rachel, next slide, please. I'm going to talk briefly about 4 things. As I said, they're not new. We're going to talk about flow-through entities and tax considerations. And then numbers 2, 3, and 4 are all priority items on the IRS, TE, GE exempt organizations audit examinations list. They love looking at employment tax, fair market value compensation and benefits, and the excise tax over $1 million of compensation to covered employees. And then code section 501R as it relates to community health needs assessment implementation strategy, your written financial assistance policy, and other documents that you need to be putting on your website and updating annually to be in compliance with code section 501R. The IRS is still looking at that and still finding fault with. So on the next slide, let's jump into the flow-through entity aspect. And today everybody's using LLCs, taxes, partnerships. They're the best vehicle generally for tax planning and tax purposes because the entity itself pays no income tax, right? And when a 501c3 participates in an LLC tax as a partnership, you need to look at the underlying activity of what the LLC is doing, because the IRS takes the position that the entity steps into the shoes of what that LLC is actually doing. So if it's a medical clinical providing LLC joint venture, generally you'll be okay, generally. If you're doing something like getting into the banking business or you're getting into the fast food franchise business, likely that will not be substantially related to your C3's exempt purposes, and you may have an unrelated business income issue. Okay, it's a little cleaner when you have a C3 and a C3 participating together as a partnership. You really only need to look at the underlying activity for relatedness. Caution, never utilize an S Corp because under code section 512E1B little I, if an S corporation is issuing a K1 to a 501c3, it is automatically always unrelated business or income or loss on that K1. So we as tax advisors do not like S Corps at all in the healthcare space, whether your entity is a for-profit or an exempt. Would always recommend starting with an LLC tax as a partnership. That's pretty clean. On the next slide, it gets a little more hairy when you have a C3 getting into a joint venture with a for-profit. And we're seeing that all the time today in healthcare, right? Ancillary medical joint ventures, MRI deals, ambulatory surgery center deals, deals with physician groups that are combining to come together and form a new entity owned jointly by, let's say, a hospital and a physician group. We also have private equity everywhere in healthcare today, and we're all using LLCs taxed as partnerships. We like to use a C3 as a tax advisor in this space. However, we can only really utilize that if the tax exempt entity controls a joint venture, 50.1% or more of the ownership of the joint venture. And in the governing documents, both the certificate of formation and the operating agreement, we like to see things like charitable purposes wording, jeopardy provisions, and certain super veto majority decision-making reserved to the 501c3 that allows us to take a reasonable basis that the K1 being issued to the C3 in a joint venture taxed as a partnership with one or more for-profits. We can take the position that K1 income is related income. Just wanted to point that out today too. A couple other things real quick before we move on. Management services, if I've got a C3 getting a K1 that's just doing management services, and we see that in private equity today, that's generally going to be UBI, so you may want to put that K1 ownership in one of your for-profits if you have NOLs, and a clinical entity, we would generally recommend putting that in a C3. And lastly, too, with these JVs as flow-throughs, we also have to consider fair market value items because obviously the C3 has to pay fair market value rent, fair market value compensation, et cetera, et cetera. So just a little highlight there today with choice of entity and what we're seeing out there as well. On the next slide, what we're also seeing today is two C3s coming together as LLCs. We would caution you if you're kind of considering that, you may want to just apply to be a tax-exempt C3 itself. An LLC could get approval as a 990 filer, an exemption, and it has valuable savings down in number 5 here from a FUTA exemption perspective. Obviously, tax-exempt borrowing you can take advantage of, and you're also generally exempt from sales use tax and municipality taxes. So in that instance, would recommend thinking about a C3 LLC as opposed to a flow-through entity LLC. So I'm going to move on to the next section of our presentation here, and employment tax audits. The IRS loves them. We talk about 3 things. Number 1, reclassifying people being treated as independent contractor workers to W-2. They love to do that all the time. Number 2, we want to talk about 1099s and W-9s. And number 3, taxability of senior management's fringe benefits and getting those on W-2s. And this slide is what we see in the IRS audit space all the time. Are we treating all the workers in the same position, the same way for tax purposes? So if you have a group of doctors and you're paying on call or department share stipends, et cetera, do you have some on W-2? Do you have some on 1099? That's like a no-no. We should be treating everybody the same. The IRS is always going to defer and try and reclassify to W-2 status. And when you look at these things, I think that's your starting point as well. They'll also look at a W-2 and a 1099 in the same individual. They'll try and remove everything from 1099 to W-2. And we've done a lot of work recently with stipends for medical residency recruitment programs, as well as nurse recruitment programs, scholarships, forgivable loans, et cetera, et cetera. Is it a W-2? Is it a 1099? Or is it a non-taxable scholarship? So it's all those sorts of things that as HR and other people in your organization are working on recruiting more clinicians to your organization. Do we have loan forgiveness tied to coming to work at the institution, which would be a W-2? So these sorts of things you need to be thinking about, and they're not new, but they're out there, and we still see significant non-compliance from taxpayers as well as the IRS auditing these issues. On the next slide, what we want to think about here is 1099 and W-2. The test is, and it's right here, it's an IRS tax tip, but generally, the question is the worker subject to the general supervision and control of the hospital, let's say? And if that answer is yes, you're going to be reclassified, your 1099 people to W-2 people. General supervision and control is the magical wording you want to take a look at. And then we've got some recommendations on the next slide here that you want to be thinking about as well in this area. You should get a W-9 from all AP vendors. Why? If you fail to issue a 1099, and you don't have a W-9, the IRS can assess tax to you at 24% backup withholding tax because you don't have a W-9 in a file. You should have written policies around 1099 MIS and the new 1099 NEC. Annually review your non-1099 required vendors. Is there a planning opportunity between box 6 versus box 1 between the MIS and the NEC? You can go online and utilize the IRS TIN matching program. You can also review both payroll and accounts payable to be sure that people were not issued both items. And then also too, annually review the senior management's compensation and benefits, fringe benefits. Is it taxable? It should be on a W-2. Is it non-taxable? Okay, why? And document the file. Also W-9s, 2 things we deal with a lot. Line 1 of the W-9, if you're using a DBA, that goes on line 2. The legal name of the entity, tax ID number goes on line 1, DBA line 2. Also, single member LLCs that are disregarded entities don't go on line 1 of the W-9, they go on line 2 of the W-9 as well. And the owner of the single member LLC's name goes on line 1 of the W-9. So over to you, Rachel. Next slide. That's a copy of the W-9, and I think we have our polling question number 3.
Yep, here is our third polling question. If your organization does not have a fully completed Form W-9 in its files and no Form 1099 is issued, what is the 2023 backup withholding tax rate that the IRS can assess? Twenty more seconds. All right, 10 more seconds. I'm gonna go ahead and close it out. All right, here are the results.
Okay, the correct answer is 24%. 30% of the people got it right. So good job. All right, I'm going to transition to two very high-profile audit examination issues. The Form 4720 is filed by exempt organizations, and you pay a 21% excise tax for compensation over $1 million to covered employees. You can have a maximum of 5 in year 1 of covered employees, but if you're a covered employee in 1 year, you're a covered employee forever. So that number 5 can go up. Well, the IRS did 842 compliance checks of 4720s last year in exempt organizations, and they referred 100 for a more detailed examination, which you don't want to do. So you should calculate the tax, remit it timely, and also make your disclosures on the 990 itself. Now, a couple of things here with the examinations. You know, and we see it in healthcare systems a lot, and it's the distinction between corporate employees and hospital employees, and who's getting the W-2 and who's issuing the W-2, et cetera, et cetera. For purposes of the 4720 excise tax, who is the common law employer of the employee? So you may be getting a W-2 from the hospital, but you're really a corporate executive working for that tax-exempt parent in the system. That's what ultimately controls. It's not necessarily an entity issuing a W-2. So watch that. Number 2, you also have to watch out for vestings of deferred compensation, because you want to try and minimize your covered employees year to year. And if you have people vesting at different years in deferred compensation, it could skew your results from 1 year to the next year, et cetera. And importantly, on the next slide, when you're referred for a compensation review, the IRS is going to look at and ask, are you compliant with the rebuttable presumption of reasonableness? And then here are the 3 factors. And we like the rebuttable presumption of reasonableness because if you qualify and satisfy these 3 criteria, it shifts the burden of proof from the taxpayer from proving fair market value to the IRS to prove non-fair market value. And that's very important. And in Form 990 Part 6, questions 15A and B, and Rachel, please flip the slide. They ask about, are you in compliance with the rebuttable presumption of reasonableness as it relates to the CEO? You can look at 15A, yes or no. But how about other people in the 990 Part 7, yes or no? And you want to incorporate the rebuttable presumption of reasonableness wording, state you're in compliance with the 3-factor test back in Schedule O of the 990 of the hospital. And also in the first part of my presentation, I talked about the taxable joint venture, a joint venture between the C3 with a for-profit entity. Look at questions 16A and B. Are you in a joint venture with a for-profit, yes or no? And do you have a written joint venture policy protecting and safeguarding the assets of the charitable tax-exempt C3, yes or no? So you want to incorporate wording there back in Schedule O as well. So you really want to stay away from executive compensation audits as much as possible. Tie it back to these 990s. You should be answering questions 15A and B, yes, as much as possible. Rachel, flip the slide, please. And I'm going to wrap up here in 2 minutes and turn it over to Schedule H and Community Benefit, where 501R is reported, and the IRS continues to do 501R compliance checks. They're also going to be revisiting community benefit audits in the upcoming years as well, and Haley and Bill will talk about that. But look, 501R continues to be a focus of the IRS. Last year, they did almost 1,300 reviews, and they referred 67 hospitals for examination. So you want to stay off the radar screen here. This has been around now for a number of years, and we still see hospitals and healthcare systems not in compliance. And this is basic blocking and tackling. Next slide, please, Rachel. Right, here's 501R. You have a needs assessment once every 3 years and an implementation strategy. And then 501R4, 5, and 6 has to do with your written financial assistance policy, as well as your billing and collection policy or a combined policy, something called a plain language summary of your FAP. And these types of documents should be posted on your healthcare system or hospital's website. And typically, not everything is updated annually. On the next slide, you'll see what we see with non-compliance issues. You need to keep, your CHNAs on your website, current and prior year ones. But look at over here on the right with regards to your FAP and your bill and collection policy. Your amounts generally billed needs to be updated annually. We don't see that. You're supposed to update your provider listing annually. We don't see that. Certain areas you need to translate your bill and collection policy, your FAP, your plain language summary, your application for financial assistance needs to be translated into languages spoken as a primary language other than in English in your primary service area. We don't see translations. We had a hospital in one particular area that had like 8 translations on its website, and then a competitor hospital like 5 miles away had like 2. So you need to be looking at your website, check your links, get these policies updated, do some comparisons to what your other competition has out there, because this is certainly an area of focus for 501c3 tax-exempt hospitals. On the next slide, we have an information document request for the IRS as it relates to 501R3 when they do an audit of your community health needs assessment and implementation strategy. And it goes to the next slide. And then on the next slide, we have a 501R IRS audit examination. You may get all these questions, you might get some of these questions, but you should do a self-assessment using these questions as a template in an annual IRS self-audit, as well as checking your website and updating all those documents on an annual basis and incorporating that into your Schedule H of your Form 990 annually. Next slide, please, Rachel. And one more, and we're going to pass this over to Bill and Haley. Thanks so much, everybody.
Great, thanks, Scott. And Rachel, I think we have our final polling question first.
Yep. Here is our 4th and final polling question. What is your hospital's community benefit percentage from its most recent Form 990 Schedule H? All right, 20 more seconds. Trying to get your votes in. All right, I'm going to go ahead and close it out. And here are the results quickly.
Great, so it looks like for most of those who this applies to, you're answering somewhere above 11%, which is great. So we can go to the first slide, Rachel. So I'll just talk a little bit about why community benefit is important. At the federal level, community benefit means exemption from corporate income tax and federal unemployment tax, as well as the ability to issue tax-exempt debt and receive charitable contributions and grants. At the state level, community benefit supports exemption from income tax and sales and use tax. And finally, at the local level, community benefit supports exemption from property taxes. Next slide. So continuing with tax exemption at the federal level, the first set of requirements for tax-exempt hospitals came from Revenue Ruling 56-185, which is known as the Charity Care Standard. The Charity Care Standard was later replaced by Revenue Ruling 69-545, known as the Community Benefit Standard, which is still the standard used by the IRS today. The current Community Benefit Standard is fairly broad and does not contain any numerical thresholds for a minimum amount of charity care or community benefit that a hospital has to maintain to keep its federal tax exemption. And years ago, the Senate Finance Committee did propose a 5% minimum threshold on Form 990 Schedule H Part 1. This proposal did not pass. However, it would have applied at the total community benefit level, not on a charity care analysis. Next slide. So just for the sake of time, these are the criteria that a tax-exempt hospital has to meet under the current community benefit standard. Could go to the next slide, Rachel. So like I mentioned previously, the community benefit standard is broad, and over the years, there have been calls to update it. So the article that's linked to the slide is from a publication called Health Affairs, which proposes a list of current community benefit standards to keep or modify. But interestingly, it also proposes the addition of some new standards. So two of the standards that they would like to see implemented are reporting the estimated value of a hospital's property tax and sales tax exemptions, and then also have a requirement to spend at least some of a hospital's surplus funds externally, specifically to address social determinants of health. Next slide, Rachel. So these next two slides just highlight some Schedule H data that's useful for your hospital or system to benchmark and compare community benefit reporting against national averages. So annually, the American Hospital Association releases a report summarizing community benefit and other benefits to the community across all Schedule H's filed with the IRS. And their most recent report is from the 2019 tax year. So this table here shows the average for financial assistance and other community benefits found on Schedule H Part 1. And as you can see here, the national averages remain fairly consistent year to year with a slight upward trend, even though for your individual hospital, you might see more fluctuation in your community benefit percentage year to year. Next slide, Rachel. And this is just a continuation of the report. Same as the previous slide, the national averages continue to be consistent with a slight upward trend. And just an important note about the full AHA report, the full report contains additional data tables that break out these averages by certain demographic characteristics, such as hospital size, type, and location. So using the full report to match these demographic characteristics to your hospital's facts and circumstances might give you a more appropriate percentage to benchmark against. And now I'll turn it over to Haley on the next slide to talk about some community benefit topics.
Thanks, Bill. So obviously we know that there continues to be increased scrutiny on community benefit. There's articles coming out at least monthly where senators are questioning certain hospital systems. For instance, in the Ascension article, the senator was asking for them to basically provide information on their community benefit, which also dovetailed into also, I want to know about your compensation, your investments. So it's kind of a slippery slope, which we've also seen with IRS audits in this topic in the past. And as Bill mentioned, there's no current federal regulations on community benefit thresholds for tax-exempt hospitals. There are 5 states that currently impose a minimum community benefit requirement, but we see some change in this area. And for instance, on the next slide, you'll see Montana, which this article was released about a month ago. Their legislation is trying to impose some community benefit guidelines that need to be met. And the bill, which is being sponsored by Senator Bob Keenan, would require the health departments to define what hospitals can count as community benefit, also detail how they must report their giving, and it would create penalties for hospitals that fall short. So this is just a trend that we expect to continue to see through other states, and a topic that is largely under scrutiny at this time. On the next slide, this is just a snapshot of the community benefit process, something that your organization should be implementing, and we encourage you to make sure that is being used widely throughout the organization. And on the next slide, I just want to talk to you very quickly about some observations that we're seeing, but more so I'm going to focus on the areas of opportunity. We see some areas of opportunity being health disparities and inequities. And Rach, if you go to the next slide, there's some more information on that. Social determinants of health has been wildly popular and something that hospitals are looking into addressing. So are these health disparities, and the heightened focus on this is something that organizations are working towards. And while they continue to work towards them, they need to take a look at the cost involved with addressing these, because we believe that these can certainly be included for community benefit purposes on your Schedule H reporting. And on the next slide, we all know that there's a huge nursing shortage, physician shortages, and because of that, there are increased costs associated with getting travel nurses, putting in place recruitment and retention incentives, and even launching scholarship and tuition reimbursement programs. With this, there's opportunity for inclusion potentially on your Schedule H. There has to be a reasonable methodology implemented. And so I would encourage anybody who has increased costs related to the current nursing shortage to speak with your tax advisor and discuss, because we believe there's certainly opportunity here. And on the next slide, we'll just sum up with the community benefit best practices, which those of you on our webinar have seen before. Largely, this should be a collaborative process. It needs to be, because that's how information is going to get to the people that it needs to get to in order to be accurately reported on your hospital's Form 990 on an annual basis. And with that, I will turn it over to Rachel to close us out.
Great. Thank you, Bill and Haley, and thank you, everyone. Before I turn it back over to Scott to close it out, we had a few questions come in, and here are all of our presenters' contact information. Feel free to email them directly with any questions that you have, and they will be sure to reach out to those who reached out with questions during the presentation. I'll now turn it over to Scott.
Yeah, thanks, Rachel. First off, I'd like to thank the presenters for joining me today during tax busy season. You did a great job. Secondly, I want to thank everybody for joining us here this afternoon. We covered a lot of topics. We tried to keep it high level. There's lots of things going on tax related in the healthcare space as well as the not-for-profit space. And we always like to say that, healthcare organizations that are tax-exempt entities or have tax-exempt entities within their healthcare system really have to comply with two parallel systems of tax, right? The 501c3 tax exemption rules, but then also the payroll and the accounts payable and 1099 W-2 payroll tax reporting rules as well. And not everybody in your institutions are tax experts. We tried to cover a lot of things today. And I want to just sum up in three different areas. Number one, you have opportunities. Lynn talked about, right, the clean energy refundable tax credits, right? Opportunity. Matt as well from the employee retention tax credit opportunity. We know the industry since COVID has been struggling, right? Decreased revenue, increased expenses. Take a good hard look at one or both of those areas for reimbursement. Huge opportunities. Number two takeaway, there's risk out there. There's continued IRS audit examinations. We had anywhere from probably 6 to 12 over the last 12 months in areas like employment tax that I spoke about, the excise tax on compensation, but moreover, the fair market value total compensation needs to be reasonable of the senior management team being reported on your 990. And are you entitled to that reasonable presumption of reasonableness? It's probably a good time to go down to HR and take a look at the compensation committee minutes, look at the compensation report, and make sure that the people you're putting on the 990 are all covered in that compensation report, right? Just a little basic blocking and tackling and going that extra yard on the 990 to incorporate that wording back in Schedule O, right? So opportunities, risk, and then I'll conclude with telling your story. And Bill and Haley did a real nice job of outlining Schedule H community benefit, providing you with some benchmarking information. But the one slide too also had Sally, right? And in the accounting world and tax world, Sally stands for same as last year. You don't want to be doing that, because I can tell you, and Haley and Bill pointed it out, the community benefit percentage is going up every year. And there's new opportunities, and your organizations are doing great things for the community. And that should be incorporated into the Schedule H Part 1. Drive up your community benefit percentages, benchmark yourself to your peers nationally and regionally and see where you're at. Get your community benefit planning committee involved, and moreover, tell your story back in Schedule O narratively of all the great things your organization does by virtue of being a 501c3 entity. Opportunities, risk, telling your stories, all real great tax-related things that you folks want to be thinking about. Again, on behalf of Bill, Haley, Matt, Lynn, and myself, and certainly a shout out to Rachel for doing a great job putting this together today. Just want to thank you for joining us again this year, and have a great afternoon.